Okay, well, welcome everyone. Today our session will be on IP valuation. We'll be talking about patent valuation methods and some of the practical considerations of those different models. Before we get started, next slide please, a couple administrative items. We will be recording today's session, and if you've registered, you will get an email later on with a link to the recording in case you want to look at this later on or share the recording with any of your colleagues. During today's session, if you do have any questions, please type them into the Q&A box, which on my screen is at the very bottom of the Zoom window. It may be on the top of yours. And we'll try to take those questions real time, or if not, we'll address them at the end of the presentation. And finally, don't forget to follow us on LinkedIn. And for more information about other webinars, check out our website at slwip.com. Next slide, please. We're very lucky today to have three great panelists. I'm your host, Doug Portnow, and I'm a patent attorney at the Schwegman law firm. And just for sake of, not in terms of importance, but in terms of the order of pictures, we have Kent Richardson, who's a partner at the Richardson Oliver Law Group. And Kent is a published attorney who is actively involved in a lot of buying, selling, and acquisition of intellectual property assets. We are also very fortunate to have today Suzanne Harrison, who's a principal and founder of the Percipience firm, which is an IP strategy firm, and also the author of Edison in the Boardroom, which is a strategy book. And finally, we also have Mark Stignani, who is a patent attorney at the Schwegman firm and in charge of the analytics department, as well as the firm's compliance officer. So with that, I'm going to turn this over to Kent and let you take it from there.
Great. Let me skip ahead a few slides here to the first one. All right, so we're going to talk a little bit about what patent valuation is and patent value as an example, why you should care about this, and then some best practices and some things that work better and things that don't work better. So next slide. All right, let's talk a little bit about value versus valuation. Go ahead. Next slide. So Suzanne, why don't you actually talk a little about value versus valuation, because this concept actually we don't learn it as lawyers, and it's an important valuation and price. So why don't you start out with this?
Yeah, so I mean, all of us talk about getting value from something or from our intellectual property. What is the value of our patent, for example? And value is a point in time estimate, right? And it can be both qualitative and quantitative, right? I mean, the worst case scenario is when someone says, how much do you love your mother? Like 4.2, that makes no sense, right? I love her a lot. That's just enough, and that's a qualitative view. And we also think of a value as contextual, right? So we talk about value to the owner or value to the investor or value to the buyer. All of those have different value estimates, as it were. And valuation is a way to prioritize where to focus attention and resources. And it always looks into the future, and it's based on a set of assumptions. And those assumptions can be assumptions about time and what you want to do with it and who the target is and all of those things. And so valuation is putting all of those assumptions together over time to give you a value estimate, which is that point in time number. Next slide.
So
go ahead.
Yeah, go ahead, Suzanne.
I was going to say, so, honestly, why does valuation matter? I mean, we use it a lot, right? And internally within corporations, it can drive investment from both what you want your internal resources, if you want to look for external sources of revenue or investment. It's about driving R&D, investment and decisions. It's about choosing what products and revenue you're going to have. And it can also help, as we said before, it can prioritize and be a proxy for importance level. Kent, do you want to add to that?
Yeah, so I mean, stepping back a little bit, there's a couple things that are really important about this. You know, what you're doing is you're creating an evaluation. Actually, you know, everybody focuses on the end number, right? That's like, oh, what's the number? Actually, there's a whole process that's important in the evaluation, and that process is building agreement among the stakeholders on how we're going to go about making a business decision, right? How we're going to say something is valuable or not valuable, or how we're going to assign value to that. And it isn't just the last number, right? So I think that's an important element. It is an ongoing process that gets you to a number, but what you have done is you build consensus around a decision-making process that you can explain to somebody, and 6 months from now, you can still explain it to them, like, this is how we came up with the answer to what we thought the value was. And that's an important distinction here. It's not just the number.
I also think, just building on that, you know, one of the interesting things about intellectual property management is that it takes 3 different functional areas, right? It takes legal, R&D, and business, and not all of those groups make decisions the same way. And so you're creating a set of decision rules for how to get more consistent decisions over time, right? Because ideally, valuation is only one, you don't do it once. You know, in certain instances you do, but usually you're doing it over time. Do we want to invest in more things in R&D? That happens all the time. You want more consistent decisions about that, in addition to being accurate.
Yeah, and if I could add to that, I think there's also a harmonization going on. You're trying to get a common language going between a finance group, a marketing group, an engineering group, and the legal counsel, not to mention the tax department. Because one of the things that, you know, as we mentioned, valuation is a continuum, or an estimate of yield, if you will, across a particular set of assets. Whereas, you know, valuation, if you're going into a transfer pricing, there's a number there, but it's, as the previous slide mentioned, it's very much in the eye of the beholder, because what is valuable in an assertion and the value of an asserted asset versus the value of something you're using to you know, transfer royalties around the world is incredibly different, and gives you an entirely different perspective when you're talking to your internal stakeholders, as well as external companies or external governmental authorities as you're discussing these points with them.
So, you know, that brings up 2 points on that context that I want to re-emphasize, and I'm going to give you a very simple example. Imagine you have a pile of gold in front of you, right? There's just a pile of gold. You know, immediate reaction for most people is, well, that's valuable. Now imagine that pile of gold is in the middle of the desert, your car's broken down, you have no communication systems, and nobody knows where you are, and you have no water. Turns out that gold is pretty much useless. If nobody's going to be around for 100 miles, you're in deep trouble. Gold is not worth anything at that point. So there's an example of where context really matters. And I think what Suzanne and Mark were talking about is the way I like to think about different people have different skills, right? Lawyers have different skill from engineers. In this context, engineers, I consider them to be the people who help make products work, right? They get products to work. Well, MBAs help organizations work, right? And this process that Suzanne was talking about and Mark's talking about is a tool for helping an organization make decisions and to move forward, especially when it's from disparate groups across the company and you're trying to get a consensus around a decision. So we're talking about valuation, but actually what we're really talking about is the way that people make decisions. And I think that's an important distinction, and I think it's something that we don't get taught very much as lawyers.
And to take your point to the next step, I mean, Suzanne mentioned how storytelling is very, very important previously before we came on here. And valuation is an incredible baseline for your story of value to shareholders, your value to a particular client or sales. And so the valuation is, again, we walk away from the pure number aspect. This is qualitatively, we're talking about the quality of this particular thing we're establishing a valuation for. So we use this as a proxy for value. We use a proxy for importance. We have as a proxy for a number of things, but it's really a baseline note in a storytelling narrative inside of a business.
Next slide, please, Michelle. All right, so we have a number of examples of where companies use valuations, and we talked a little bit about some of these. That internal decision making, new product, new service of investment versus maybe going and buying something like that. So that's literally evaluation. When we have resource and budget allocation, so we used to use a relative valuation process in setting budgets. So I used to manage a decent sized portfolio at Rambus, and we would rank order our patent assets so that we could resource and budget allocate. So we didn't have exactly a final dollar number, but we had a dollar estimate of assets of a certain type had a higher dollar probability, and therefore we were willing to invest more money in. And that's an example of where you use a valuation method to figure out how to allocate resources. Mark, you want to talk about taxes?
Yeah, I mean, a number of the secret hidden agendas of a lot of intellectual property, especially of large corporations, is to establish a valuation. Now, over the last couple of decades, a lot of companies have been in the news for their Irish twists or their double Dutch dipping Irish pips with a half gainer. And a lot of the European Union has kind of thrown some of that into the air and to the wind. So one of the things that evaluations are really incredibly important for and receive a high level of scrutiny for is really where something is invented, the transfer prices that you are going to be charged or pay to intra-company transfers, and then how ethically and responsibly you can put that in front of a tax authority and gain this basis. So the whole basics of tax planning with IP is that you file patents around technology that will be used in a high tax jurisdiction, and you own it in a low tax jurisdiction. In 2017, there was a fair amount of litigation and new laws around that, which tries to slow that down. But in essence, there is a process and product of where people use to get royalties from high tax jurisdictions or low tax jurisdictions using intellectual property. And how they get there with valuation is you set a valuation for both the risk and the technological innovation at the earliest possible time in that. So you may actually invent something. You have an R&D in a number of different countries. You bring those together. You file transfer pricing papers on those at the earliest stages before they're actually granted as IP assets, and then you treat them as royalty-bearing income tools for moving assets out of high income jurisdiction, high tax jurisdictions to that. So one of the things that is probably not highly used is in the tax planning space, where people will again literally create intellectual property for the purposes of defining an asset for movement, but for tax purposes. So that's kind of the baseline there. So you have a valuation at the point of origin, in the country of origin, and you try to own it in a different country, where you can then charge royalty-based revenue on that. Then from there, you would, as the continuum of valuation occurs, as you get new sales or new deployments of that technology in markets where you have revenue-based sales, you can then increase that valuation going forward and on, through the life of the asset. And with patents, you have a essentially a 20-year asset lifespan that you are able to then, do repeatable revenue royalty streams for as the life of the technology, as long as it's been used. So that's one of the kind of the oddball valuation things that I have done previously in different lives and also advising different clients as they go forward. Most multinational corporations have some form of this going on. And despite the best efforts of the tax authorities, Apple, you may have realized, just news got a $13 billion judgment against them overturned, utilizing very similar structure to a tax purpose and a tax planning, structure of some sort. I'll stop talking now. Let everybody else jump in.
Sure. So, another area is like transactions, just buying, selling patents, M&A. What happens when you buy a company or you buy a set of assets and there's some intellectual property, you may be required to put them on your books with a number. Now, let's say you paid $100 million for a company, and they might want to know, the accountants might want to know, for the 250 patents, how much of that 100 million was related to those patents, because it wasn't broken out in the deal. So you have to find the number to put on those patents. I just closed a deal not too long ago where we took royalty payments and patents. And so we had to use a valuation process to figure out what number we should put on those patents that were transferred. Suzanne, you do a lot of, or have done a lot of litigation work. Let's talk a little bit about
Sure. I mean, litigation, again, it's either for damages in the case or for settlement negotiations. And so, I guess what's interesting when I look through this list is that intellectual property can both be a legal asset and a business asset. And you also have to figure out which one you're valuing, because that tells you some rules and methodologies under which you're going to do that. So when you're going to utilize a valuation, again, get that context. That's the most important thing. That helps you pick a methodology, and then you can begin to work through some of the assumptions that you need as part of that.
And then also for, when you're talking about investment decisions, right?
Yep.
Well, one other thing if I could add is that this is also really, really crucial for disposals, abandonments, donations as well. Again, going back to tax purposes again, where you're trying to establish a rationalized value for either your charitable contribution or what you're writing off on the books as well. So again, that might actually lead into some of the SEC stuff that I think, Kent, you were going to address.
So why don't we go on to the next slide, and then we'll come back around to some more specific examples. So I think one of the most important things, and this is really hard for lawyers, because the first thing that happens with any valuation model is it's going to be wrong to some degree, because you're basically predicting the future. And so, I've been in a fair number of investment banker presentations with, when I was in-house general counsel and executive and do a lot of M&A. And so the bankers would come in and say, well, here's all the companies you could buy, and here's what we think the value is. And I've never left one of those meetings without the CEO saying to me, well, that was all a bunch of garbage, right? So all of those models were wrong. But the point is not that they're supposed to be perfectly right. You have to understand why and how they came up with the valuation model. And then you have to sort of come back and say, how are we going to get agreement around how we're doing this? So, I think that idea that these are perfect is the wrong way to think about this, right? It is right for the need, the level of precision, the level of accuracy, and the number of outside variables you're going to include has to be sort of right sized for the use case. So how are you going to use this model? Suzanne, comments on this?
Yeah, I mean, let's talk about when you're going to use evaluation. So if you're an engineer and you walk into your patent attorney's office and you say, I have an idea, and you sit down and you talk about it, what you guys are going to try and figure out is this idea worth $1 or $1 million, right? I mean, at that level of magnitude, you just need to know which end of the spectrum is it on, right? Versus if you're going to be sitting on the stand giving a damages number, people want you to be right. They want you to have things really nailed down and not to be making an educated guess. So know the audience, know what it's going to be used for, but also understand that, again, if any of us could predict the future, we wouldn't be sitting here on this webinar. We'd be sitting on our own little island, minding our own business, having a nice life. So it's really, really hard. also, I think for companies, when you do evaluation and then, you know, the future rolls over and you're there and you realize all the things you weren't right about, why were your assumptions wrong? Was it because you didn't have good information, which happens all the time? Was it because you just made a crappy guess, or you didn't spend enough time thinking about it, or you forgot a significant factor? And again, that becomes important if you're going to do it over and over and over again. You want to learn and also begin to look at the corporate wisdom, because over time you'll have data that you can begin to incorporate into your own valuations. Your own history becomes data.
Yeah.
Okay. There's also a thing when you're in-house that if you are not continually revisiting your evaluation, at least on an annual basis, if not on a biannual basis, you don't have the opportunity to fix it. So if you put evaluation aside 5 years later and you're looking at it 5 years later and you haven't revisited it since that time, there's something wrong in how you're putting things together, because your internal books and especially how you account for intangibles is going to be off by several magnitudes after 5 years of not revisiting evaluation. So I'm a fan of doing it often and eliminating the noise by iteration.
I think the other thing that's really important is to get a handle on what are you going to do with the valuation? What decision is the valuation going to lead you to make? And what's interesting is when you get all the folks who want to have the valuation and you sit them in a room and you start talking about what you want to do with that, what is the decision or the outcome going to be? It's never a united front. In fact, everyone trying to get consensus on that is probably the most important thing. And also just having a conversation about how is this going to work? What process are we going to use? Again, who gets to be in it? That conversation is often more valuable than the end value number that you get, because you get everyone to have a consistent understanding of what's going to happen, but also what are you going to do with it? What's the purpose?
Well, and so for the folks that are lawyers online, where this really shows up in the valuation is in all the limitations and what the disclaimers in the valuation. There's like a page and a half around what this valuation is for, what the context was, what the assumptions are based on, and what assumptions are sort of more important or less important, and what you're allowed to use the valuation for is critical, because it definitely defines how much rightness you need in that model. Next slide. Next couple slides, actually. We're going to get into some basics now.
So if I could just jump in real quick, reminder to our audience that if you do have any questions, please feel free to type them into the Q&A box. I do have one question for our group, and I'll just read that to you. And the question is a company's written down valuation estimate discoverable in litigation? Does anyone want to address that?
So yeah, so that is a great question, because I do both. I am a lawyer and valuation. So when we do valuations, we will start as the lawyers, but basically as soon as they get handed over to the outside accountants, the privilege is gone, right? And we know that, and we know that that's what's going to happen. So the short answer is, for them to be useful for something where it's an audited valuation, something that shows up at the SEC, then the short answer is it basically has to be discoverable. Now, if you ask the former general counsel of Intellectual Ventures, who had hundreds of models on litigation outcomes and how much money they were going to make, if any of those were discoverable, the short answer is none of those were discoverable, because they were never shown to anybody and never put together for any other reason than the legal team to make decisions, informed business decisions. So those ones were not discoverable. So I think that gives you some sense. It depends on who makes it, what the reason is, and who had access to it.
Okay, good. Thank you. I think, Suzanne, you were going to talk next.
Yeah. So I run a best practices group, and I have for the last 25 years. And one of the things we did early on was we said, how do you guys use intellectual property and other intangibles? And so they, went to the whiteboard and started putting stuff down, and then we organized it in this way. And you can see that the role of intangibles shows up, whether it's conflict avoidance, revenue generation, cost reduction, strategic position, and any company probably uses 2 or 3 of these, and really focuses on those as its true value drivers. And when you think about any of these, the role of know-how in improved knowledge transfer, those are the kinds of things that could denote evaluation, right? If you wanted to know, okay, we're going to do an in-kind contribution into a company with our intangibles. We want to know what that value is as part of NewCo. That would require evaluation, as an example. And so these are just some of the very different ways that companies are even utilizing intangibles, and that, again, you have to come up with what is the context for what you want to look at. So I will say, I often have had questions from board members where they say, we want to value our portfolio. And I say, great, for what? Well, all of it. Oh, so you want the litigation value, the strategic position value, the revenue generation value. Okay, so now we're into multi-millions of dollars. And then what are you going to use it for? Well, I just want to know. No, right? That's just not feasible, right? So again, it's super interesting. Intellectually, it's super interesting, but it doesn't always make sense to do evaluation just because you want to know.
Yeah, and that reminds me of like painting the Sydney Harbor Bridge. By the time you got to one end of the portfolio, you'd have to start back at the beginning again.
Exactly.
Because it would have changed. So I think it's important to understand, different parts of intellectual property can support different use cases and therefore different value streams. And what you really do when you model this is you kind of pick the primary value stream that the executive team is trying to make a decision. So a classic one in Silicon Valley, where we do a lot of high-tech company work, is the counter assertion value of the patent portfolio. If somebody comes after us for patent infringement, what do we have in our portfolio that we can use to counter assert against that company? And that value, you can actually put some parameters around it and get a sense of what the numbers look like to see if you might be over-invested somewhere, under-invested, have a fair bit of exposure. You use some of the analytics work that, some of the tools, and it gives you some sense of, how you're budgeting and spending your money. And that's an example of where you pick the specific, use case, and you didn't account for all the other sources of value, which can be still important and significant, but you were looking at that one component of value.
Yeah, and that comes up a lot. I would say in the best practices group, we have a lot of questions about how do I right size my portfolio? And the answer is, okay, how are you looking at it? Are you looking at it for productization? Are you looking at it for revenue generation? Assertion value, or counter assertion value? Again, you have to pick each one of those value streams and look at what's important in your portfolio. And chances are different patents are important for different value streams. And then the sum of that in its entirety is what you need to achieve all of those goals, whatever they are.
One thing that I wanted to point out, though, is that there is only a certain finite number of things that you can do with valuation. If you're using it for litigation, you probably shouldn't be doing valuation for tax purposes because they start to go cross purposes. When we were putting together portfolios for counter assertion, we wanted to make sure those were clean from some other tax assertion or tax assessment where we would give up assertable value for lost profits and things like that. So very much like as you're building your corporate IP asset base out, you have to pick and choose where you're going to value, how they're going to be valued, and how they're going to be asserted or defended or transferred in that. So you can't do one thing that fits all. And painting the Sydney Bridge is not a viable thing, I think, in managing an internal portfolio for value.
Yeah, I think that's right. One just observation for those that haven't done both, like evaluation and legal work. The valuation should be objectively, solid opinion. So we're not looking for an advocate type of opinion. We're looking for an objective, independent opinion, which now your client may not always like the valuation you're coming up with, right? And I think that's an important distinction from what you would do as a lawyer, which you tend to be an advocate and you try to put a compelling position down that supports your client's basis. For valuation work, what you're trying to do is much more objective. It's objectively, the model can stand by itself. Different people with different interests can look at it and say, well, okay, well, those are reasonable assumptions. I may not agree with everything, but I get where you're coming from. And that's a important distinction from legal work versus valuation.
And let me just jump in with a quick question to our panelists. Any comments about certifications? For example, specifically, what is the value of a certified patent valuation certificate?
Suzanne, you should know this stuff more than I do.
Yeah, I mean, I think that valuation is funny because there's not really a standard to do it, right? And so having, you know, certification programs, LES has tried this in the past, is useful at least to get people to better understand how to do evaluation and what are the important components of evaluation. I think a lot of it depends on, you know, what companies are willing to support, right? If they want to have more standardization, then I think these things are important.
But I think that question, even being more specific, is, you know, for the folks who have not done valuation, if you wanted to get into it, it's not a crazy idea to go.
Yeah.
Yeah, I mean, it could be a table stakes thing for if you're hiring a team out, but I mean, at the end of the day, it's like having you know, a degree in software doesn't mean I'm a great programmer. The opportunity here is that, you know, what else does that person bring besides the certificate? I mean, I have a privacy background as well, and I passed the IAPP, you know, exam, but it has virtually no bearing on my ability to, you know, give, you know, good consultative advice on something. So I tend to say, you know, it's nice to have.
Yeah, especially if you don't have other experience. I mean, I think it's helpful there.
Okay.
Excellent.
Back to you, Ken.
Yeah.
Next slide.
Yeah.
So, you know, there are three main types of valuation methods. Market method, which is comparables driven. Income, which is looking out in the future, putting income streams and then discounting them back to present day. And then there's cost, which is what you use when you cannot use the other two. You start from how much did it cost for me to create this? And so, you know, when you're valuing intangibles, you're going to use some version of one of these. And the trick is to figure out what is the best one that you can use and the highest and best information you have. And that makes the most sense. But you can see the advantages and disadvantages of using this, each of these.
Well, why don't we talk a little bit about like some of these, what they mean, right? So what's the difference between a market versus an income and a cost? Why don't you walk people through some of those, because I think it's important.
Sure. So market, when you're doing evaluation, you want to say, look, has somebody, it's like, think about housing for a second, right? We don't go, oh, I wonder what that house costs if I'm going to buy it. No, you look on the MLS to see what other comparable houses have sold for. And that gives you a price range using historical data of other comparable assets to what you could expect. So it kind of gives you some bounds as to what's a reasonable amount for that asset. One of the questions that comes up around intangibles is whether or not they're so unique that there is something comparable. And the answer is there's always something comparable. But you know, you can argue the differences of your intangible vis-a-vis someone else's. But you know, there may not always be market data.
So and Suzanne, on that point, I mean, I think there's an interesting thing, you know, as patent attorneys or intellectual property attorneys, a lot of folks here, by definition, a patent is an invention of something that never existed before. So
Right.
By definition, there should be no comparable, right? That's the baseline. Now, that's also true for every house, because by definition, the house next door cannot be my house. Right? They're both unique. So one of the things about looking for comparables is how accurate of a comparable do you need, again, for the purpose of the valuation, right?
Right.
So,
so for example, your technology solution could be novel and unique, but it could only be one of several other ways you could achieve that same endpoint in technology, right? So you could do it by type A, type B, type C. B and C may have sold recently so that you have some sense of what a comparable technology prices are. And again, now you're arguing how yours is different from that.
Well, and so when you think about the comparables, and again, for a market, what you're trying to do is say, in an arm's length transaction, what would this asset go for? Like, what price would it go for when you're doing this? And so when you think about a house, what are the things that matter? Okay, what's the zip code it's in? How many square feet it is? How many bedrooms it has? Right? How old it is? You know, that gives you a fair bit of information immediately. And so you can start to see that you can decide, depending on how accurate you need your analysis to be, how many variables you're going to include.
So I think one of the questions is, well, how do you get this data, right? A lot of these comparable transactions are actually shrouded in secrecy or confidentiality. But there are ways that you do that. So the first thing is, you know, for naked patent transactions, Richardson Oliver has created a database of patent prices or potential patent prices and all the patents that are selling. So that's an example of one way to do that. SEC filings have a number of those. Industry associations have licensing rates for different technology groupings. You can find some data sources that may give you estimates or types of value things around comparable, some aspects of the transaction that you can use as comps for what you're doing. So yes, a lot of these things are done in secrecy, and yes, there are ways to find some public data around some aspects of these.
And if I could interject on the analytics side, there are a number of qualitative and quantitative measures that you can use to generate approximations. If you have, public companies you're evaluating, you can say this percentage of the portfolio is approximate to this line of products that they're announcing revenues for. You can start to get, again, proxies, but a much better proxy than guessing, and really kind of hone in on a particular aspect of an invention or a particular aspect of a device for establishing a market value for it. So it's actually, there's a lot more ways to get there analytically than simply the various transactional databases out there. But happy to talk more about that with the question asker.
Suzanne, why don't you talk about income now?
Yeah, so income approach says that from the asset you're going to be, whether it be a product or a service, what is it going to generate in income over the next period of time? Let's just pick a period of time, let's say it's 5 years. And so you're putting in a whole series of both costs and revenue projections around that, and a whole bunch of assumptions around what the market's going to look like, et cetera. And so there's a lot of, as you just heard, there's a lot of assumptions, right? So it's only as good as the amount of time and effort you're going to spend on making good assumptions. And you also want to have ways that you can document where those assumptions come from, so you can figure out as time rolls on whether or not those were good. Right. And so this one just takes a little more time and is a way, I think, in fact, most companies, when they're making internal decisions, are using some version of the income approach to estimate whether or not they should invest in a technology to come into a product or service down the road.
And then with the tax transactions as well, the income basis is probably the preferred way of doing it, but there's a factor of risk, and you add your evaluation in accordance with the level of risk being accepted by the transaction as well. So that gets more and more particular once you get into taxes, tax transfers.
And then cost. Oh, sorry, do you have more?
Yeah, actually, the one thing one thing as a lawyer I'm not a big fan of on the income basis is, if you don't have a royalty rate, you have to put a royalty rate down. Now remember, these things are often discoverable, not always, often discoverable. And what you did is you put a royalty rate down. So that's something that will be used against you somehow. So it's something to be aware of and be careful of using the income basis for it. It's definitely completely reasonable, done a lot. If you have an established royalty rate where it's pretty defensible, that's great. In high tech, for example, this is hard to do. In biotech, it's much easier to do.
Yeah, so I think it really depends on the industry and whether or not there are industry standard rates.
Yeah.
And again, you can find those out if there are. But think about, this is one of those ones where you want to think about how you want to attribute where the number came from. So again, sometimes having a third party number that you can use, then you can argue, this is the number that, you know, we got from LES, and this is why we are different from that industry standard, right?
And I had one of those actually. So, you know, it doesn't happen in the US as much, but, you know, European countries, Australia does national surveys of licensing rights and it publishes those rates. I think Denmark does them, and some of the other Scandinavian countries have done it. But I was in negotiations on a deal, and it was a high-tech patent. It was a small portfolio, Australian company, and they looked in, you know, whatever information technology category, which was really broad, and they saw that the rate was 15%. So they wanted 15% royalty on their patents. Now, in high tech, that makes no sense. 15% is very unsupportable, except in extraordinary situations. So you have to be careful about what did it mean to have this royalty, and what they had done is the 15% number was actually on software where the code was delivered. It wasn't a patent license. It was where people had delivered the code, functional code. And so they had misused the royalty rate information and had gotten confused and completely kind of screwed up their negotiations, ended up getting zero because they came in with such a number that was unsupported and didn't understand where they're coming from. Sorry, go ahead with costs.
Yeah, so the cost basis is just recreating the cost it took you to create the technology. Again, it's what you use. It is my least preferred method. But when you have no other recourse, this is what you use. The difficulty with this method is, you know, if you created something and you sucked at it, it took you 5 years because you were busy doing 14 other things, and it took you $5 million, it doesn't mean that somebody else today starting over and being very focused on it wouldn't do it in less. So it really, it's difficult to connote value to it. It is what it cost you, but it doesn't have any sense of whether that was the preferred way or the ideal way or not, or you went down every rat hole, you know. So somebody who learned from those mistakes and did it differently would come up with a different number. I have seen it. It comes up in litigation in a number of different ways, but again, it's not the preferred way.
So I was on calls with the accountants yesterday, and I had a model up where we had done a valuation, and I happened to have some of the leftovers from a cost model in our standard starting Excel template for this work. And so the accountants were starting to get really excited about the cost model for the patents, and I just had to kill the whole conversation immediately. I'm like, look, doing the cost model for patents is not the way you want to do any of this valuation. I'm going to delete these rows right now because this is a draft. We're completely deleting everything about the cost model because it's so unhelpful, except in extraordinary cases for intellectual property. So
it's purely the backstop of anything else, because it's like, you know, having a trade secret defense. You want to do everything else before you get to cost models. So
next slide. So let's talk a little bit deeper into some of these examples. So Suzanne, you know, let's talk about you do a fair bit of early stage work.
Yeah. So, you know, many years ago, I was a financial analyst for Hewlett Packard, and I was the liaison to R&D. So theoretically, my job was to kill all the projects coming out of R&D if they couldn't meet the return on investment hurdle that was required. So a lot of this stuff is early stage, and we say early stage, it means it's going to take multiple years to come to fruition, right? So now we're guesstimating into the future or predicting into the future what's going to happen. So a lot of the difficulty with early stage valuation is that there are a number of technical hurdles that need to be jumped before you can even get to a product. And then once you get to a product, there are a number of market hurdles that need to be jumped to make it something that is, going to be viable product selling in the marketplace. So oftentimes what happens is you have to make what we call probability adjusted assessments to get us to even a product that's ready to sell. So let's talk about that for a second. So if I have an early stage technology, and in order for it to get to something that could be productized, there are 4 key technical stages that have to come to fruition, right? And so what you want to know is you have to define what those 4 technical hurdles are, and then you want to have some discussion about what is the probability that we will get past hurdle 1. What is the probability we'll get past hurdle 2 that we won't come to a technical issue we can't solve, right? And so again, you are now creating probability adjusted guesses as to whether or not you're even going to be able to get this thing to a product at all. And then once you do that, now we are going to go through all the normal market hurdles of penetration and pricing and competitors and all of those things about whether or not we'll be successful in the marketplace. And so putting all of those together is a way to get a risk-adjusted early stage valuation for internal decision making.
And that's the valuation of the company, and then you have to back out which portion of that would be the value attributable to the intellectual property.
You can do it for both, actually. I've done it for a product and I've done it for a company. Again, sometimes the company is the product. So, those 2 things can collide a little bit, but if you're Hewlett Packard, it's one product at a time. But if you're looking for your Series A financing, those 2 things are pretty much the same, the product and the company oftentimes.
There was a question, was interesting. It says like, this stuff is not on the radar of many companies. Some cases they just want patent numbers. In other cases, they just don't care. Why should these companies start caring about the valuations they're discussing? So that's an interesting point. We've got some examples, but the one actually, really clean ones, one of the groups that Suzanne worked with was Dow Chemicals. And Dow was able to look at 40 years of data to see when products came off patent and when they were patented. And they could look at what their margins were when something was patent versus not. And it turned out to be a huge number. I think it was, as I recall, Sharon saying it was like $300 million was attributable to the patent portfolio of Dow Chemicals based on simply the margin they were able to, and the exclusivity they were able to command. So that's an example of where, this stuff mattered. It mattered to them, and the people who did the math actually were the finance team. So,
right. So here's a really important thing to take away. Finance people don't like talking about patents and valuing patents because nobody ever agrees. So if you're going to do a deal, the investment bankers never want to talk about patents because that just bogs everything down and no one can reach agreement. What they want to do is reach an agreement on the price, and then they're going to try and back into what is the patent or intellectual property value within that price range. So, one of the things that I think as you get more sophisticated, you want to help companies to say, no, let's actually, if you think the patents or the intellectual property is your strength, you want to put forward what you think those value streams are, right? A patent is an option on a potential value stream. The more of those value streams you can articulate and you can show what that value is, the more likely you're going to increase your price. So thinking about that and understanding how those value streams work and articulating that is likely to be a negotiation point for you if that's how you want to put it forward. But if you want the finance people to do it, they will never talk about that because it's very difficult for them because they're not patent people or intellectual property people, and they don't know how to put that in.
Yeah, and there's a flip side to how getting people interested in in valuation as a practice. One of the things that you have to put in front of a finance person is the word billion. In many cases, especially if you're dealing with a multinational, if you're talking millions of dollars in valuation and that stuff, it just doesn't even raise their eyebrows. So one of the reasons that we spent a lot of time working on taxation values and taxation planning using IP is that it really does drop to the bottom line, words like billions. And so for the companies that are engaged in this practice, it is worth a lot of time and a lot of effort. For the companies buying, I agree, absolutely. You start with an asset base, a purchase price, then you try to, figure upside or downside based upon the intellectual property. The only caveat here is that if you find a company's lied about their assets or overstates their valuation, it can drop the valuation much further than the actual value of the assets and can kill the deal. I've had several tens of deals fall through because the patent story just didn't hold water.
So, and that's actually an interesting one. So when Yahoo was spinning out Excalibur, there was a Wall Street Journal article. Somebody had interviewed somebody on Wall Street and they said, oh, it's got to be worth $3 or $4 billion. And there was no thought process behind that statement at all. And I think this is damaging to intellectual property lawyers, and it's damaging to valuation experts for two reasons. The first one is if we have people way overestimate or way underestimate the value of what we're creating or helping to create, then resources won't be allocated properly, expectations are misaligned, executive teams expect to make billions or they expect to make nothing. Both of those cases are not true, right? So that's a problem for us. The other problem is there is no explanation of how you got to that number, so it feels fake. It feels so artificial and, like pulling just the numbers out of the air, is that it sounds like there's no way you could ever understand it, and it sounds fanciful. Right? So I actually ended up writing an article about it, and we back the envelope using our data about buying and selling, and we came to $700-ish million was the ballpark number. And actually came out, I don't know, about 2 months later, that the number the company put on it was about $700 million at the time. So there is a methodology you can apply to all of this stuff, and just guessing is really bad for all of us. It just makes us look like we're not professional, we don't have a practice that makes sense. I mean, there's a bunch of things that are really bad for us. So I think that's one of those stories that really resonated at the time. For me, it was utterly fanciful and completely not tied to any actual numbers or methodology. And we're running a little bit out of time, and maybe any of these specific examples that you want to talk about more, Suzanne, Mark?
I think the one that everyone on the call can walk away from with a little more help is the M&A example. So I think that chicken and egg, when you start your valuation on M&As, is really critical to communicate early. Because if you're going to find upside, if your company has a white paper they're trying to make, and they suddenly start looking at the patent attorney to come up with that additional, $5 to $10 million to make that board paper work, it's the place where I found the most problem stepping into a valuation process, latent process. So the earlier you get involved with M&A, look at the IP, look at the valuation problem in front of you, and come to some sense of an answer to that sooner than later.
So I think there was a question about books or blogs or other resources. So for intellectual property valuation, I would say Richard Razgaitis, Russ Parr, Patrick Sullivan, all of those have written really good books about different aspects of valuing intellectual property and other intangibles as a way to understand those things. I would say that if you're interested in doing internal valuations within the company, some of the edits in the boardroom, we have best practices about how companies make better decisions, and some of those around valuation and some of those around other aspects, other decisions around the intellectual property management decision process. And I think, Ken and Mark, what else would you say about other places to go?
So intellectual asset, intellectual asset media group has a bunch of valuation articles by different folks. I did one on an Intel portfolio about 4 months ago, and it was just, how do you ballpark, you know, thousands or hundreds of assets to get a ballpark number, kind of what I did for Yahoo. So there's some there. IP Watchdog has a few articles, and then our website, richardsonoliver.com and ROI Patents both have articles on, you know, market-based pricing, which, you know, there was questions about how do transactions that are confidential, how do you get the information? Well, it turns out the information is anonymized and aggregated. And so that way, just like industries do this fairly often, like how do people know how many chips are being sold by different companies or what the price points are? Turns out there's anonymization and aggregation of that data, and then it's reported out, so confidentiality is maintained.
And I tend to go extra law. I tend to go to the taxation blogs as well as the IFA, or International Fiscal Association. They have a lot of interesting words and articles around transfer pricing, intellectual treatment of tangibles into different marketplaces as well. So go there.
Why don't we go to the last slide where we talk about some best practices.
Sure.
So again, I think, you know, doing the numbers, running the numbers is actually the easiest part once you have all the assumptions. So let's talk about what some of these best practices are. So what decision are you going to make from the valuation? Getting a handle on that begins to tell you what kind of valuation you're going to need. What's the bucket of intangibles to be valued? Again, try to make sure you have everything that you want to be valued in this. Is it patents? Is it patents and trade secrets? Is know-how involved or relationships? What is it? What's that bucket?
And it's just a point of caution here. This is actually not as simple as you would think. So we now do these we get the list of the assets as an attachment to the valuation, simply because you'd be surprised how that list can just change over the course of 2 months when you're already working on an analysis.
Exactly. Then also trying to figure out what's the appropriate context. Am I doing it for tax purposes, for accounting purposes, for an internal decision, for an external investor? Understand what that context is, because you will know for tax purposes, okay, does the tax authority require a specific methodology? Again, your choice of methodology may depend on the context. And what level of precision is necessary? Do I need to die for this thing, or is a swag okay? Like, help me understand how much time and effort I'm going to spend and the resources for me to get the right answer.
There's also another. So some of it is 10 million versus 11 million. Does that matter, or is it any number above $250,000 matter, or is it 50 million or 200 million? Like, what level of precision or on the billions, right? So, you know, you have to kind of ask what matters to people. Like, do they care if it's $100 million? Well, if it turns out it's a $4 billion valuation, they probably don't care. But you have to ask the question. So, go ahead.
And then who should be involved, right? Are you doing it with different functional groups in the company? Are you looking for an independent valuation expert to do it? Are you, who are all the people that need to be involved in this decision? And then how long is the valuation expected to be valid? It's a point in time. Like, if the valuation comes to you, the report comes to you today, is it good a year from now? Is it good 6 months from now? So what is your window to make your decision for that report to be valid? And then who gets to use the results and for what purposes? This is what Kent and Mark were talking about earlier. Turn that over to you guys.
Oh, go ahead, Mark.
No, I was, very much about the best practices here is that you really need to partner. If you're an attorney, partner with an accountant, partner with a financial tax assistant of some sort. Because one of the questions is how do you get into this when you come from patent law? Well, you don't really, unless you are forced into these situations and become uncomfortable enough to get partner with good people. So the best practices are, work cross-functionally.
So the way I got into it is I was in-house for 10 years. And basically this is how the business units ran their decision-making.
So into Mark, a question just came out is what aspects of valuation work is typically done by the legal team? So why don't you guys answer that?
Well, I mean, from the analytics standpoint, you're actually looking at the assets themselves for scope, coverage, design around things that are, are they impaired in some way? So you're actually, trying to, is there any there from an intellectual property law standpoint? And then from there, you actually, the actual value or the number comes up with your advisory to the finance or taxation or accounting team is the way I do it. But
yeah, so typically that's the diligence is like legal diligence often. There is a level of understanding about patents, which actually finance doesn't have. And so, for example, there's a lot of preconceived notions about how patents have to work. And that is true in some industries and not true in other industries. So there's this idea that, oh, there was the one patent that rules them all, and that was the one that matters the most. And, in high-tech stuff, there are some more important patents and less important patents. But, typically it's thousands of patents being cross-licensed. So the idea that you can quickly identify such a patent doesn't really exist. And so that's an example of something that, the lawyers, that's not part of your legal diligence. But the accountants have a preconceived notion about how this works that they need to be disabused of. And your responsibility is to help them understand that patents in this context don't work the same way they might work over in this other industry.
I also think it's important for the patent attorneys to have a sense of what patents in your portfolio are valuable for different value streams. What are your key patents for litigation against competitor X? What are your key patents related to product Y? What are your crown jewels? So you should have some sense of what that is. You don't need to have 100%, but you need to know at the 75 to 80% level what some of those are.
Okay, we're actually at the top of the hour. So if you have any final comments, 30 seconds each, anyone?
I think don't get scared by valuation. It's a really useful process and the conversation is incredibly valuable. And just know that whatever answer you get is not necessarily supposed to be 100% right, but it's supposed to help you make better decisions.
Mark, final comments, Mark?
This is an iterative process. Don't be sold on your first number ever. And make sure you test the assumptions as you go into this. It's a great practice.
Kent, you get the final word.
Yeah, I think this is something that is different when you're doing it, not as the lawyer, but as valuation, and it's really much more about being objectively defensible, and you're less of an advocate than you are, and I think that's a little bit of a harder thing to keep your head wrapped around when you're a lawyer.
Okay, well, great. I want to thank all of our subject matter experts, Suzanne Harrison, Kent Richardson, and Mark Stignani. Also want to thank Brianna Williams and Michelle Forsberg for helping put all of this together. And most importantly, thanks to our audience for joining us today. And we look forward to hopefully crossing paths with everyone again in the future. And check out the slwip.com website for future webinars. Thanks and have a great day, everyone. Bye.
Thank you. Bye-bye.
Bye.